In this lecture, we're going to study gold. Gold is a very, very interesting commodity, precious metal. It's all kinds of things. I mean, it can be a currency at some times, it can be a safe haven, it can be a commodity. Gold is, of course, very fascinating. Throughout history, gold has had a history, long history as a currency. So 5,000 years, people, human beings, traded goods around the world and exchanged gold in return. It has a strong fundamental acceptance widely across the world. And so now, of course, in the last 100 years, after the world has moved into paper assets, what we call paper assets rather than physical currencies, gold has taken on new meaning, and we'll take a deep dive into the gold charts as well. Now, gold is priced in US dollars, so it fluctuates with the US dollar, inversely with the US dollar. If the US dollar gets stronger, then the price of gold falls. And if the US dollar gets weaker, then the price of gold increases. So you can imagine. So what does money printing do? Money printing is one way of causing some kind of inflation in the market, because you're flooding the market with more money. And therefore, that's inflationary, which means we are bringing the USD, the value of the US dollar, down. So because all that extra money that goes into the market actually reduces the value of all the existing dollars in the market. So that's why it's money printing causes the US dollar to weaken and therefore gold to rise. So all of these things, you can see it on the charts, and gold is definitely something you can invest. In fact, most financial advisors and the smart people will tell you that gold should be a small part of your portfolio. Gold can be the ultimate safe haven, because if you looked at the bond markets section earlier, we saw that there are some perils in the bond market. There are some things that can cause the entire global financial system to crack. And if that happens, then gold is likely to rise a lot. So that is a very extreme scenario, of course. But you have to consider it, because we came very close to that in 2008. Before that, we had the dot-com boom and bust. And so these asset bubbles are beginning to happen at much more regular intervals now. And all of it has to do with the money printing, the low interest rate, which causes asset bubbles, and many other things. So we do live in a fairly dangerous world that way. And so you have to look at gold's ultimate ability to store value. Let's go see the gold charts first and look at gold from a historical perspective. /GC is the gold futures. You can even do GLD. It doesn't matter. They are going to look the same. So let's go back to the gold futures, because that has a long history right here, back up to 96. Back in the 90s, this was the time, the late 90s was the time where the internet boom was happening. Nobody wanted gold. The economies were booming. The US markets were booming. We were all in that internet.com frenzy that time. And so nobody really was interested in gold. Gold touched a low of about $253 an ounce over there. And then since then, once the dot-com bubble burst around 2000, 2001, you can see that gold steadily starts climbing into 2007. What we are looking at here, now this period is interesting, because you would have expected gold to behave like a safe haven right here. This was when the 2008 crash was happening, and all through that year, gold never really acted as a safe haven. So it's very interesting why it did not do that, because there was a sense of crisis, there was a sense of panic, but it did not act as a safe haven. And why did it not do that? And so you have to, I'm going to use this as an example for you to understand the correlationships between a few different asset classes. If you think of what happened during this 2008 crisis, US banks were in trouble. So they were pulling all their money out from every corner of the world, wherever they had any investments, any kind of cash, they were pulling all that out. Then even in Europe and Asia, because of the magnitude of this crisis that was developing, the European markets and the Asian markets just did not know what to do. And so they liquidated whatever investments they had. And where did they go for safety? And this is really the irony of it, is that all this mayhem is happening in the United States. But still, during this time, all the European markets as well as the Asian markets were pumping their money into the ultimate safe haven, which was the US bond market. If we go and look at the US bond market, we've taken a look at it, but let's go take another look at it. If you look at the US bond market, now this is where it does a 40% jump that time. So all kinds of foreign investors were coming in to buy US bonds. Now you have to bear in mind, when foreigners are coming into the US and want to buy US bonds, they are coming in with their currency. So whether it's a euro or a yen, whatever it might be, they have to buy US dollars, because in the US bond market, you can only invest in US dollars. You cannot invest Japanese yen into the US bond market. So they have to convert their local currency, whether it's a yen or a franc, whatever the case might be, and they had to buy the US dollar. And so for the same period, let's go look at the dollar index and see what happened there. And as you can see, in the 07-08, the dollar index goes high. Demand for dollars just got ramped up a whole lot in 2008. And so the price of the dollar also went at a low of 71. And also within 9 or 10 months, it's at 90. So that's like a 25% jump, 30% jump in the US dollar. So if the US dollar rises, then gold must fall. So I know this is like a very convoluted correlationship that we are just studying here between bonds, currency flows, and gold. And so these are all interconnected. Some correlationships are very strong and they will work all the time. So which is the US dollar and the price of gold. That is a solid relationship, and it's an inverse relationship. If the dollar is strong, then the price of gold must fall down. It's an inverse relationship. So if gold goes up, then dollar is down. And if dollar goes up, then gold is down. So that's how you have to look at it. And so during this time, because of the demand for US dollars, and even though the crisis was happening in America, it might come as a surprise to see this. The US dollar actually reached a pretty decent high during that time. And then we also saw that the bonds, US bonds, also reached a good high during that time. If we come back to gold, which is /GC, and perhaps now you can understand why gold actually went down that whole year. So it was at a high of $1,000 an ounce, went down to 671. That's a 30-40% drop right there. So this is a big drop, even though it doesn't look like it, but it's a pretty big drop. And then see what happens now. So how did the crisis get over and how was it resolved? Well, central banks stepped in, bailouts, and lots of issuing new bonds for this, money printing basically. And so what happens during money printing? It's inflationary, and therefore the price of gold has to go up. And so it hit a high of about 1923 back in 2011. And after that, it's been steadily coming down. It tries to go back there, but gets rejected, steadily coming down. Just the last 2 months here in 2016, January and Feb, we are seeing a pretty decent uptick. So, it started out around 1050 and we are at 1250. So that's a 20% jump in the last 2 months. So that's pretty good for gold because it's not seen that kind of a rebound. As you can see, it's not seen that kind of a rebound for many, many years. And so you wonder, this is one more thing that tells you that smart money is concerned about some things in the global markets. Even the bonds are telling us that. The bonds are close to all-time highs. With the money going into gold in the last 2 months, that is also telling us that something is wrong. I mean, there is a pretty big concern out there, which as retail investors, we may not be able to pinpoint our fingers on, but collectively, you can see that smart money is pretty concerned about this. Gold is a very interesting phenomenon. And, like we said, at this time, when you expect it to act as a safe haven, it did not. And the reason for that was because investors were piling into the US bond market, and therefore they had to pick up US dollars, which sent the US dollar skyrocketing. And in turn, that brings the price of gold down. So that's how that works. Gold is an interesting asset class, and we know that it has a history of reliability. And of course, gold cannot get spoiled. Gold lasts through centuries and millennia. So it's definitely a store of value. It's something the entire world looks up to, whether it's for jewelry or just as a measure of wealth. So gold is a very popular asset class across the world, and so it's not going to go away anytime soon. Gold is always going to be there, and there's only a limited supply of gold. Unless some new reserves and new technology comes about and finds more. But it's the same case with oil. There's a limited supply, and we need oil to run the world. So similarly, gold is a precious metal. It can be a currency. It can be a safe haven. It can dance to many tunes at one time. What you may be surprised by is during times of crisis, when money is pouring into the US for safety, at that time, gold does not behave as a safe haven. But now, if the USD itself is in trouble, let's say like we discussed in the bond section, if there's something like the bond crash, then I think that is the time gold will really start to shine, because there won't be any other asset to run to. And I see that gold and silver also perhaps at that time would be the real stars if such a thing happens. So anyway, that's it for gold. In the next lecture, we're going to study oil. And after that, we're going to look at some trading instruments for both gold as well as oil. And I do want to take a GLD trade as well, which is the gold ETF.